Welcome to CFP Exam Prep. Today we're diving into a crucial topic that often appears in the exam: financial planning standards and the fundamental process of understanding client circumstances, setting goals, and implementing plans. Let's break down the core concept of gathering client information. The CFP board emphasizes a comprehensive approach that goes beyond just collecting financial data. You need to understand your client's values, attitudes, expectations, and time horizons. Many candidates make the mistake of focusing solely on quantitative information like income and assets, while overlooking qualitative factors such as risk tolerance and family dynamics. When assessing client circumstances, remember the five key areas: financial position, including assets, liabilities, and cash flow; protection needs, covering insurance and risk management; investment objectives and constraints; tax considerations and implications; retirement and estate planning goals. A common exam pitfall is failing to recognize how these areas interconnect. Goal setting is another critical component that requires both art and science. The SMART framework is essential here. Goals must be specific, measurable, achievable, relevant, and time-bound. For example, instead of setting a vague goal like save for retirement, a SMART goal would be accumulate $2 million in retirement accounts by age 65 through monthly contributions of $2,000. The implementation phase often triggers confusion in exam questions. Remember that implementation follows a specific sequence. First, you must obtain client agreement on recommendations. Then develop an action plan with specific steps and timelines. Finally, coordinate with other professionals like attorneys or tax advisors when necessary. Test questions frequently present scenarios where candidates must identify the correct sequence of implementation steps. Here's a practical example that often appears in various forms on the exam. A client wants to save for their child's college education while also building retirement savings. The mistake many candidates make is jumping straight to product recommendations without first establishing priorities and analyzing trade-offs. The correct approach is to first understand the client's complete financial picture, evaluate competing goals, and then develop an integrated strategy that addresses both objectives within the client's resource constraints. When it comes to monitoring and reviewing the plan, pay attention to triggering events. These include major life changes like marriage, divorce, or career shifts. The exam often tests your ability to identify which circumstances require plan modifications versus those that might only need minor adjustments. Documentation is another area where candidates lose points. Remember that all client interactions, recommendations, and decisions must be properly documented. This includes recording when clients decline to follow recommendations. The exam might present scenarios where you need to identify what should be documented and why. One final critical point involves understanding the differences between the 7 steps of the financial planning process. A common mistake is confusing developing and presenting financial planning recommendations with implementing financial planning recommendations. The former focuses on creating and explaining solutions, while the latter involves putting those solutions into action. By mastering these fundamentals of financial planning standards, you'll be better prepared to handle related questions on the CFP exam. Focus on understanding the process as a whole, while being able to drill down into specific components when needed.